To understand the recent turmoil in Washington, we must first grasp the role of the Federal Reserve, the central bank of the United States. The Federal Reserve, often simply called the Fed, is one of the most influential institutions in the world of finance and economics. Its decisions ripple through every corner of the American economy, affecting not just Wall Street, but also Main Street, impacting the lives of everyday Americans in ways both visible and hidden. The Fed acts as the bank for other banks, maintaining a stable financial system. It provides a safety net for the banking sector, ensuring that banks have access to emergency funds when needed, and that the payment system, the backbone of our economy, runs smoothly and efficiently. Created by Congress over a century ago, its mission is to keep the economy running smoothly and prevent financial crises. The Fed was born out of a time of frequent bank failures and economic instability, designed to be a safeguard against the kind of panics that once threatened to bring the entire financial system to its knees. Its most famous tool is setting the federal funds rate, the interest rate banks charge each other overnight, which influences everything from mortgages to credit cards. When the Fed adjusts this rate, it sends signals to the entire economy, affecting how much it costs to borrow money, how much people spend, and even how businesses invest in growth. By raising or lowering this rate, the Fed can stimulate a sluggish economy or cool down inflation. Lower rates make borrowing cheaper, encouraging spending and investment, while higher rates can slow things down, helping to keep prices in check when inflation threatens to spiral out of control. The Fed's dual mandate is to promote maximum employment and stable prices, a delicate balancing act. Achieving both goals at once is no easy feat, especially when the economy faces shocks from unexpected events, like global pandemics or geopolitical tensions. Its leaders, appointed for their expertise, are meant to be insulated from political pressure. This structure is designed to ensure that decisions are made based on data, research, and long-term thinking, rather than the shifting winds of politics or public opinion. This independence is intentional, ensuring decisions are made for long-term economic health, not short-term political gain. The Fed's ability to act without interference is seen as essential for maintaining trust in the financial system and for making tough choices when they are needed most. The Fed's credibility and the nation's financial stability depend on this principle. If the public or markets lose faith in the Fed's independence, the consequences could be severe, undermining confidence, increasing volatility, and threatening the very stability the Fed was created to protect. That very independence is now under unprecedented threat, raising urgent questions about the future of the Fed and the stability of the American economy itself. On January 9, 2026, the Department of Justice served grand jury subpoenas on the Federal Reserve, a move that sent shockwaves through Washington and the global financial community. The news broke suddenly, catching even seasoned analysts and policymakers off guard. For decades, the Federal Reserve has operated with a degree of independence rarely challenged so directly by law enforcement. Now, that tradition was being put to the test in a very public way. A grand jury subpoena is no ordinary request. It signals the launch of a criminal investigation, not just a routine inquiry or regulatory review. The legal weight behind such a move is immense, and it immediately raises the stakes for everyone involved. The official explanation for the subpoenas centered on the renovation of the Fed's historic headquarters, as well as Chairman Powell's recent Senate testimony about the central bank's budget. On the surface, these might seem like straightforward matters of oversight, but the DOJ's demands were sweeping, calling for extensive documentation and communications. They framed the probe as a matter of fiscal accountability, insisting that transparency was essential for public trust. Yet, a crucial detail stands out. The Federal Reserve isn't funded by taxpayer dollars. Its operations are financed independently, raising immediate questions about the true motivation behind the investigation. Was this really about fiscal responsibility, or was something else at play? Many observers, from legal experts to political commentators, began to suspect that the renovation was merely a pretext. They argued that the subpoenas were a tool for exerting political pressure on the central bank, rather than a genuine pursuit of justice. The timing of the DOJ's action was especially notable. The subpoenas came on the heels of a year marked by President Trump's increasingly vocal and public demands for the Fed to slash interest rates even further, despite resistance from within the institution. Critics argue that this marks a dangerous escalation, from heated political rhetoric to the use of legal force. The boundaries between government branches and the independence of the Fed, now seemed more fragile than ever. The conflict has shifted dramatically, moving from public criticism and political posturing to an all-out legal battle. At the heart of the fight is the very principle of the Fed's independence, a cornerstone of the American financial system. Now, the specter of criminal charges hangs over those steering the nation's economy, casting uncertainty over the future of the central bank and raising the stakes for everyone who depends on its stability. In response, Chairman Jerome Powell released a forceful video statement, calling the DOJ's investigation a pretext for punishing the Fed's refusal to yield to political demands. Powell warned that the threat of criminal charges is an attack on the Fed's independence, not a dispute over building renovations. He emphasized that monetary policy must be guided by data, not intimidation. Drawing on his bipartisan service, Powell vowed to continue his duties with integrity, refusing to be pressured or resign. By speaking directly to the public, Powell reframed the conflict as a test of democratic institutions. He challenged the DOJ and White House to justify their actions, arguing that the stability of the U.S. economy is at stake. The battle lines are now drawn in the court of public opinion. President Trump, in an NBC interview, denied any involvement in the DOJ's subpoenas, distancing himself from the investigation. He insisted the probe was unrelated to his criticism of the Fed's interest rate policies, but used the moment to again attack Powell's leadership. Trump claimed he would never use the DOJ to pressure the Fed, yet repeated his view that rates are too high. This denial, paired with continued criticism, has fueled skepticism in Washington. Critics point to a pattern. Trump publicly calls for investigations, then claims ignorance when action is taken. The White House has deferred questions to the DOJ, which remains silent. The president's words have only deepened concerns about political motives behind the attack on the Fed's independence. The subpoenas and Powell's response triggered rare bipartisan alarm on Capitol Hill. Lawmakers from both parties condemned the DOJ's actions as a threat to the Fed's independence and economic stability. Republican Senator Tom Tillis vowed to block any new Trump Fed nominees until the legal matter is resolved, a significant act of defiance. Democrat Elizabeth Warren accused the administration of abusing DOJ authority and called for a halt to Fed confirmations. This united front signals the administration may have crossed a line even allies won't defend. The defense of the Fed's independence has become a rallying point, raising the stakes for the White House. The conflict now involves Congress as a check on presidential power. Central bank independence is the principle that allows the Federal Reserve to make crucial decisions, like setting interest rates and managing the money supply, based solely on economic data and expert analysis, rather than on the shifting winds of political agendas or short-term government priorities. This means the Fed can act in the best interest of the economy, even if those choices are unpopular with politicians or the public at the time. Without this independence, there's a real risk that politicians could pressure the Fed to lower rates before elections or boost the economy for short-term gain, regardless of the long-term consequences. Such interference could lead to runaway inflation, destabilize markets, and ultimately harm everyday Americans by eroding their savings and increasing the cost of living. The Fed's unique structure is designed to prevent this. Governors serve long, staggered terms, and the institution is funded independently, not through the annual congressional budget process. These features shield the Fed from political cycles and allow it to focus on its mandate: stable prices and maximum employment. These safeguards ensure that monetary policy decisions are grounded in careful analysis and real economic indicators, not dictated by the pressures of election years or partisan interests. This helps maintain a steady hand during turbulent times. Independence is what gives the Fed credibility. When markets, businesses, and savers trust that the central bank is acting impartially, they have confidence in the value of the dollar and the overall management of the economy. This trust is essential for stable growth and investment. If that trust is shaken, borrowing costs can rise, markets may become volatile, and investment slows down. The ripple effects can be felt across the entire economy, from Wall Street to Main Street. That's why recent DOJ subpoenas targeting the Fed are seen by many as a direct threat to its credibility and independence, raising concerns about political overreach. If the Federal Reserve is perceived as just another political tool, uncertainty and risk will ripple through the economy, making it harder for families and businesses to plan for the future. The stakes are not just technical or abstract, they touch every American's financial security, from the value of their savings to the stability of their jobs and the prices they pay at the store. That's why the debate over central bank independence isn't just about policy. It's about protecting the economic future of every American. This isn't just a Washington drama. It could impact your wallet, job, and savings. If the Fed loses independence, monetary policy could serve political interests, not economic health. Artificially low rates might spark inflation, eroding your savings and raising everyday costs. An independent Fed can make tough choices to protect your money's value. Political interference undermines global trust, raising interest rates for everyone, on mortgages, car loans, and business financing. This slows the economy and threatens jobs. The worst-case scenario, a crisis of confidence in the U.S. financial system, triggering market crashes and soaring borrowing costs. The Fed's reputation as a steady, apolitical institution is a key economic advantage. If that's lost, every American could feel the pain. That's why economists and lawmakers are sounding the alarm. With Powell standing firm and Congress united, the standoff has several possible outcomes. The Fed must respond to the subpoenas, likely sparking a court battle over its independence, potentially reaching the Supreme Court. In Congress, senators' pledges to block Fed nominees could create a leadership crisis as Powell's term nears its end. The Fed could be left in limbo, with markets facing uncertainty. Business and global market reactions will be crucial. Negative responses could pressure the White House to back down. International condemnation could add diplomatic weight. The administration must decide, escalate the fight or seek an off-ramp, perhaps by quietly ending the investigation. The chosen path will shape the future of the Fed and U.S. economic policy. The stakes are enormous, not just for officials, but for the entire country. The world is watching. Ultimately, this story is about two things: your financial stability and the health of American democracy. The Fed's independence is a safeguard for your savings, job, and future. When that independence is threatened, so is the predictability families and businesses rely on. The DOJ's actions raise troubling questions about the use of government power and the rule of law. If prosecution becomes a political tool, trust in the legal system erodes. This conflict is more than a policy dispute. It's a test of our institutions' resilience. The answers will shape both the economy and democracy for years to come. That's why everyone should care.